In 9 days, one election in Japan could shake the largest bond market on Earth. 40-year government bonds are already breaking records, and behind closed doors, officials are making emergency calls across continents. But this isn't just about Japan anymore. Germany, the country that once enforced fiscal discipline, is suddenly borrowing at historic levels. The UK's bond yields have now climbed higher than the crisis that toppled a government. 3 major economies, one fragile system, and a single trigger that could push borrowing costs, mortgages, and markets worldwide into chaos. The real question is not if something breaks, it's what breaks first, and who feels it the fastest. Welcome to Market Metal. If you're someone who's spent decades building savings, protecting your family, and planning a peaceful retirement, consider subscribing, not for hype, but for clarity when the noise gets loud. And before we begin, tell us in the comments, which country are you watching from today? The trigger, Japan and the fragility of the global bond system. The global financial system often appears stable on the surface, but beneath that calm there are pressure points that can change everything very quickly. One of those pressure points now sits in Japan. In the coming days, Japan faces a political event that markets are watching very closely. Investors, banks, and government officials are not focused on stock prices or headlines. They are watching something much deeper, the bond market. This is because the bond market is the foundation of modern finance. When it becomes unstable, the effects do not stay inside one country. They move across borders, across currencies, and into everyday borrowing costs for households and businesses. Japan is the world's 3rd largest economy. It is also the country with one of the largest government debt loads in modern history. The total amount of Japanese government debt is measured in the trillions of dollars. In simple terms, this means that over many years, the government spent more money than it collected in taxes, and it filled that gap by borrowing. Borrowing itself is not unusual. Many countries run deficits. What makes Japan different is the scale of that borrowing and how long it has continued. For decades, Japan managed this situation through a very specific policy choice. The central bank kept interest rates at or near zero. This meant the government could borrow huge amounts of money while paying very little interest. When interest costs are low, even large debt can appear manageable. Governments can refinance old bonds with new ones without facing sharp increases in payments. This environment created a sense that Japan's debt, while large, was stable. However, financial systems do not remain frozen forever. Over the last period, interest rates in Japan began to move higher. Even a small increase matters when the total debt is extremely large. When rates rise, each new bond issued by the government carries a higher interest cost. As older bonds mature, they must be replaced with new ones at those higher rates. This process is called refinancing. It sounds technical, but its impact is simple. The government must now spend more of its budget just to pay interest. This is where the situation becomes sensitive. Rising interest payments reduce the money available for other priorities such as infrastructure, healthcare, or defense. If spending does not fall, the government must borrow even more. That creates a loop. More debt leads to higher interest costs, which leads to even more borrowing. Markets watch this loop very carefully because it can move from manageable to unstable faster than expected. At the same time, Japan is entering a political period that adds uncertainty. Elections often encourage leaders to promise more spending or tax relief. These promises can be popular with voters, but they also raise questions about how the government will pay for them. When investors believe future spending will rise without clear funding, they demand higher interest rates to compensate for the risk. This is how politics and bond markets become tightly connected. In recent market activity, long-term Japanese government bond yields have moved higher. Long-term yields are important because they reflect how investors view the country's future stability, not just its current conditions. When long-duration bonds begin to show stress, it is often an early signal that confidence is weakening. Traders and institutional investors pay close attention to these moves because they can indicate deeper structural problems. The reason Japan matters globally is not only its size, but also its position inside the international financial system. Japanese institutions, banks, insurance companies, and pension funds hold large amounts of foreign assets. Over many years, these institutions invested abroad to find better returns than were available at home. This means that financial stress inside Japan does not remain contained. If domestic conditions worsen, these institutions may need to sell foreign holdings to raise cash or reduce risk. This creates a possible transmission channel from a domestic bond problem to the global market. If Japanese investors begin to sell foreign government bonds or other assets, prices in those markets can fall. When bond prices fall, yields rise. Rising yields increase borrowing costs for governments, companies, and households in other countries. In this way, a change that begins inside Japan can spread outward through financial connections that were built over decades. Another important factor is the structure of Japan's economy itself. The country faces slow growth compared to earlier periods in its history. When economic growth is low, tax revenues tend to grow slowly as well. At the same time, Japan has an aging population. A larger share of citizens are retired, which increases spending on pensions and healthcare. Fewer working-age people are available to support those costs through taxes. This demographic shift makes it harder to stabilize public finances. Low growth, combined with high debt and rising interest rates, creates a difficult balance. If the government increases taxes, economic activity may slow further. If it increases spending, borrowing rises. If it cuts spending, political pressure grows. Markets understand this dilemma. That is why even small changes in policy or political signals can lead to large movements in bond yields. From a systemic perspective, Japan can be seen as the first potential domino in a sequence. The bond market is highly interconnected across major economies. Investors compare yields across countries. If risk rises in one large market, capital can move quickly into or out of others. This movement changes exchange rates, liquidity conditions, and funding costs. Because Japan is both a major borrower and a major investor abroad, it sits at a critical junction in that network. Financial history shows that bond market stress rarely announces itself with a single dramatic event. Instead, it often begins with small shifts, slightly higher yields, increased volatility, and cautious language from officials. These signals can appear technical, but they represent changing confidence. Once confidence weakens, markets can move much faster than policymakers expect. At this stage, observers are not claiming that a crisis is certain. Rather, they are identifying conditions that increase vulnerability. Large debt levels, rising interest rates, political pressure for more spending, and demographic headwinds together create a fragile environment. In such environments, unexpected events, policy changes, election outcomes, or shifts in global capital flows can trigger reactions that spread beyond national borders. Japan's position as a major holder of foreign assets adds another layer of importance. If domestic stress forces institutions to rebalance, those actions can affect benchmark interest rates worldwide. Because many financial products, from mortgages to corporate loans, are priced relative to government bond yields, even moderate shifts can influence the real economy. For business leaders, investors, and policymakers, the key lesson is not that Japan's situation is unique, but that it reveals a broader pattern. Many developed economies share similar pressures: aging populations, slower growth, and rising debt burdens accumulated during years of low interest rates. Japan is simply further along this path. Its bond market movements provide an early view of challenges that others may face. In this context, the current attention on Japan is less about one country or S finances and more about the stability of the global bond system itself. When the largest and most liquid markets begin to show strain, risk does not remain isolated. It travels through capital flows, currency markets, and investor behavior. Part 1 therefore establishes the central concern. Japan's large debt, the shift away from zero interest rates, political incentives for additional spending, and structural demographic pressures have combined to create a sensitive moment. The recent movement in long-term bond yields is not just a local market event. It is a signal that the foundation of the system is under review by investors worldwide. If confidence holds, conditions may stabilize. If it weakens further, the effects will not stop at Japan's borders. The contagion channel, from Japan to the United States and the global capital system. In global finance, crises rarely spread through headlines first. They spread through balance sheets. When one large player is forced to adjust, the effects move quietly through the system before the public even notices. This is why many analysts are not only watching Japan's bond market itself, they are watching what Japan owns outside its borders. That is where the true transmission risk sits. Japan is not just a large borrower. It is also one of the largest lenders in the world. Over many years, Japanese banks, insurance companies, and pension funds invested heavily in foreign assets. They did this for a simple reason. Interest rates at home were extremely low, sometimes near zero. Returns abroad were higher. By investing in foreign government bonds, especially those issued by the United States, Japanese institutions could earn more income while still holding assets considered relatively safe. This strategy worked well during a long period of stable rates. However, when conditions change at home, these same positions can become a source of pressure. If Japanese bond yields rise and domestic losses increase, institutions may need to free up cash. The fastest way to do that is often to sell foreign holdings. This is not a political decision. It is a balance sheet decision driven by risk management and regulatory requirements. Japan holds a very large amount of U.S. Treasury securities. U.S. Treasuries are not just another asset. They are the global benchmark for risk-free interest rates. Mortgages, corporate loans, credit markets, and even many derivatives are priced relative to Treasury yields. When the Treasury market moves, the entire global cost of money moves with it. If Japanese institutions begin selling even a portion of their Treasury holdings, the immediate effect is increased supply in the market. Basic market logic applies. When supply rises and demand does not increase at the same pace, prices fall. When bond prices fall, yields rise. Higher yields mean higher borrowing costs across the economy. This is the first stage of contagion. It does not require panic. It only requires steady selling pressure. A few large institutions adjusting their portfolios can shift yields more than many smaller investors combined. Because the Treasury market is so central, even moderate changes can influence mortgage rates, corporate financing, and government budgets in multiple countries. There is another layer that makes the situation more sensitive: the structure of global funding strategies. For decades, investors used what is known as the yen carry trade. The idea was simple: borrow money in Japanese yen at very low interest rates, convert it into another currency, and invest in assets that paid higher returns. The profit came from the difference between the low borrowing cost and the higher investment yield. This strategy expanded across many asset classes. It supported demand for U.S. bonds, equities, and other global investments. Over time, the total size of these positions became extremely large. As long as Japanese rates stayed near zero, the trade remained attractive. But when rates begin to rise in Japan, the math changes. Even a modest increase in borrowing costs can reduce or eliminate the profit from these trades. When that happens, investors start to unwind positions. Unwinding means selling the foreign assets they bought, converting funds back into yen, and repaying the original loans. If many participants act at the same time, selling pressure appears across multiple markets simultaneously. This is the second stage of contagion. It is not limited to government bonds. Stocks, corporate bonds, and emerging market assets can all be affected. The process is mechanical rather than emotional. Risk models signal rising volatility. Funding costs increase. Leverage becomes more dangerous. Positions are reduced. History shows that funding trades can reverse faster than they build. During stable periods, positions accumulate gradually. During stress, they unwind quickly because participants are trying to reduce risk at the same time. This creates sudden moves in prices that seem disconnected from economic news. In reality, they are the result of balance sheet adjustments. When U.S. Treasury yields rise due to foreign selling or funding stress, the impact moves directly into consumer finance. Mortgage rates in many countries are linked to long-term government bond yields. Corporate borrowing costs also increase. Companies delay expansion, reduce hiring, or cancel projects. Consumers face higher loan payments. The shift begins in financial markets but ends in the real economy. There's also a feedback effect. Higher yields increase government interest expenses. Larger interest payments widen fiscal deficits. Wider deficits require more bond issuance. More issuance adds supply to the market, which can push yields even higher. This loop is not immediate, but once it starts, it becomes difficult to reverse without policy intervention. Another important factor is investor psychology. Global markets often treat U.S. Treasuries as a safe haven during uncertainty. If stress is localized, money can flow into Treasuries and push yields lower. But if the stress originates from a major holder of Treasuries, the effect can be different. The market must weigh two opposing forces: safe haven demand versus forced selling. The outcome depends on which force is stronger at that moment. Currency movements also play a role. When Japanese investors bring funds back home, demand for the yen can rise. A stronger yen reduces the value of foreign earnings for Japanese exporters and can slow economic activity. At the same time, a stronger U.S. dollar, often seen during global uncertainty, can tighten financial conditions worldwide because many international loans are denominated in dollars. This interconnected structure means that what begins as a technical adjustment in one country, a bond market, can influence funding conditions across continents. Banks become more cautious, credit spreads widen, liquidity in certain markets becomes thinner. None of these changes make dramatic headlines at first, but together they create a more fragile environment. The scale of global capital flows amplifies the effect. Modern financial markets are deeply linked through derivatives, hedging strategies, and cross-border investment mandates. When volatility rises in one major market, risk models across institutions update at the same time. This leads to synchronized adjustments. Even investors with no direct exposure may reduce positions, simply because overall risk levels have increased. From a strategic perspective, the concern is not that Japan will sell all foreign assets. The concern is that even partial adjustments, combined with carry trade unwinding and rising domestic yields, could shift global benchmarks enough to change financial conditions everywhere. Bond markets operate on expectations. If participants believe selling may continue, they demand higher yields in advance. This is how a domestic funding issue becomes a global liquidity event. The mechanism is quiet but powerful. Balance sheets tighten, leverage declines, and the cost of capital rises across multiple sectors. Businesses feel it through financing terms. Governments feel it through higher debt servicing. Households feel it through mortgages and consumer credit. Part 2, therefore, highlights the transmission pathway. Japan's role as a major international investor, combined with the unwinding of long-standing funding strategies, creates a channel through which local stress can influence global markets. The process does not rely on panic or speculation. It is driven by incentives, risk management, and the structure of modern capital flows. If conditions stabilize in Japan, this channel may remain dormant. If pressure increases, however, the same connections that supported global liquidity for decades can begin to operate in reverse. When liquidity retreats instead of expands, volatility rises, and financial systems become more sensitive to shocks. That is why observers are not only watching Japan's domestic indicators. They are watching cross-border flows, funding costs, and the behavior of institutions whose decisions can quietly reshape the price of money worldwide. Europe, under pressure, Germany, and the quiet erosion of fiscal discipline. For many years, Germany was viewed as the financial anchor of Europe. When other countries struggled with deficits or rising debt, Germany was the country that insisted on rules, limits, and discipline. It promoted strict budget controls inside the European Union and often pushed other governments to reduce spending during crises. Investors trusted German government bonds because they believed Germany would always protect its fiscal stability. That reputation became one of the strongest pillars supporting confidence in the euro area. Today, that pillar is beginning to show signs of strain. Germany's recent fiscal decisions reveal a quiet but important shift. Government spending has increased, and new borrowing has reached levels that would have been considered unacceptable in earlier years. This change did not happen overnight. It developed gradually as Germany faced slower economic growth, rising social costs, and new geopolitical pressures that required higher defense and infrastructure spending. Each individual decision appeared reasonable. Together, they have started to reshape the country's financial trajectory. Germany still presents itself as fiscally responsible, but the numbers now tell a more complicated story. The federal budget includes large new borrowing commitments, and some of that borrowing is being placed outside the traditional budget through special funds. These off-budget structures allow spending to continue without formally violating certain limits. Technically, the rules are respected. In practice, the overall debt burden continues to grow. This matters because Germany's credibility has always depended not only on what it says, but on how strictly it follows its own framework. One of the most important elements of that framework is the constitutional debt brake. This rule was designed to limit deficits and prevent excessive borrowing. It became a symbol of Germany's long-term commitment to fiscal discipline. When exceptions and loopholes begin to appear, investors notice. Confidence does not collapse immediately, but it weakens at the margins. At the same time, the broader European rules also come into focus. The European Union established deficit limits for member countries to maintain stability across the region. Germany was historically the strongest supporter of those limits. Now, its own deficit levels are moving above the thresholds it once enforced on others. This reversal carries symbolic weight. If the enforcer begins to bend the rules, markets start to question how strong the system really is. Behind these policy shifts lies a deeper economic challenge. Germany's growth has slowed significantly. Industrial production has faced pressure from changing global demand, energy costs, and increased competition. Some sectors that once powered export strength are no longer expanding at the same pace. When economic growth weakens, tax revenues do not rise as expected. Governments then rely more on borrowing to maintain spending commitments. Demographics add another layer of pressure. Germany, like several developed economies, has an aging population. A larger share of citizens are retired, which increases spending on pensions and healthcare. Meanwhile, the working-age population grows more slowly. Fewer workers support more retirees. This structural shift raises long-term obligations. At the same time, revenue growth becomes harder to achieve. Social insurance systems illustrate this tension clearly. Healthcare and pension programs require steady funding, yet their costs increase each year. Governments face limited options. Raising taxes further can slow economic activity and create political resistance. Cutting benefits risks public backlash. Borrowing becomes the path of least resistance, even if it increases long-term vulnerability. As borrowing rises, interest costs follow. When bond yields move higher, even modestly, the total interest bill grows quickly because it applies to a large stock of existing debt. This is the beginning of a feedback loop. Higher yields increase interest payments. Higher payments widen deficits. Wider deficits require additional borrowing. Additional borrowing can push yields higher again if investors demand compensation for rising risk. Germany is not yet in a crisis, but the direction of travel is what concerns analysts. Fiscal systems rarely fail suddenly without warning. Instead, credibility erodes slowly. Each new exception, each off-budget fund, each upward revision of borrowing projections becomes another data point for investors. Over time, these signals can change how markets price risk. Germany's importance extends beyond its own borders. Within the euro area, German government bonds are treated as a reference point for stability. Many financial institutions use them as high-quality collateral. If confidence in German fiscal strength weakens, borrowing costs across Europe can rise. Countries with already fragile finances may face even higher yields as investors reassess the entire region. Another challenge comes from the economic cycle. Germany has experienced periods of weak or negative growth in recent years. When growth is low, it becomes harder to reduce deficits because spending needs remain while revenues stagnate. If interest rates remain elevated, the margin for fiscal adjustment narrows. Governments must either accept higher debt or implement measures that could slow the economy further. This creates a policy trap. Stimulus can support growth, but increases borrowing. Austerity can reduce borrowing, but risks recession. Markets understand this dilemma and often respond by demanding higher yields when they sense that long-term solutions are unclear. Rising yields then make both options more difficult. Central bank signals also play a role. When monetary policy tightens or remains restrictive, governments cannot rely on ultra-low borrowing costs as they did in the past decade. The era of easy refinancing fades. Debt that once seemed manageable becomes more expensive to maintain. Investors begin to distinguish more sharply between countries based on fiscal credibility. Germany's situation therefore represents more than a national budget issue. It reflects a broader transition in the global financial environment. During the years of extremely low interest rates, many governments expanded spending because the immediate cost appeared small. As rates normalize, the true weight of accumulated debt becomes visible. There is also a reputational dimension. Germany's strength has long supported confidence in European financial architecture. If that strength appears less certain, capital may seek safer alternatives or demand higher compensation for holding euro-denominated assets. This does not happen overnight, but small shifts in portfolio allocation can gradually change funding conditions across the region. From a systemic perspective, Germany sits at the center of Europe's fiscal network. If its borrowing increases and yields rise, neighboring countries often experience similar pressure. Investors compare relative risk. If Germany pays more to borrow, others must offer even higher yields to attract buyers. This dynamic can widen spreads and increase fragmentation inside the euro area. The most important point is not that Germany has already lost control of its finances. The concern is that the structural trends, slow growth, aging demographics, rising social obligations, and increasing reliance on borrowing, are moving in a direction that reduces flexibility. In a stable global environment, these pressures might remain manageable. In a volatile environment, they can amplify shocks. Part 3, therefore, shows how the second major pillar of fiscal credibility is being tested. Japan represents the early stress signal from a country with extreme debt levels. Germany represents the erosion of discipline in a country once known for strict limits. When a system loses both its strongest example of restraint and its largest buffer of stability, investors begin to reassess risk across the entire structure. The situation remains fluid. Markets are not reacting to a single event, but to a pattern. Each new budget decision, each revision of borrowing forecasts, each change in growth expectations adds to that pattern. If confidence holds, adjustments can be gradual. If confidence weakens, yield movements can accelerate quickly. In that sense, Germany's current trajectory is less about immediate crisis and more about reduced resilience. The country that once enforced fiscal boundaries is now navigating its own constraints. For global markets, this shift matters because stability in one major economy often compensates for stress in another. When multiple anchors begin to drift at the same time, the system becomes more sensitive to the next shock, wherever it appears. The UK stress test and the global sovereign debt feedback loop. By the time attention shifts from Japan and Germany to the United Kingdom, the pattern becomes easier to see. The issue is no longer about one country making difficult fiscal choices. It is about several major economies facing similar pressures at the same time. The United Kingdom now represents a late-stage stress test within this sequence, an example of what happens when markets begin to question both fiscal stability and political certainty together. The first signal appears in the bond market. Long-term UK government bond yields have risen to levels not seen in decades. In simple terms, investors are demanding higher interest to lend money to the government for long periods. Rising yields do not always mean a crisis. Sometimes they reflect stronger economic growth. In this case, however, the increase has occurred even as monetary policy has shifted toward easing. That contrast is important. When central banks lower policy rates but long-term yields still climb, it often indicates that investors are more concerned about fiscal risk than short-term growth. Higher yields immediately affect government finances. The United Kingdom already carries a significant debt load relative to the size of its economy. When the government issues new bonds at higher interest rates, future interest payments increase. Over time, these payments consume a larger share of the national budget. Money that could support infrastructure, education, or healthcare is redirected towards servicing existing debt. This dynamic becomes more serious when deficits remain persistent. If yearly spending exceeds tax revenue, the government must continue issuing new bonds. Each new issuance adds supply to the market. If investors are cautious, they require even higher yields to absorb that supply. This creates a reinforcing loop. More borrowing leads to higher yields, and higher yields increase the need for further borrowing. Political conditions influence how markets interpret this loop. Investor confidence is not based only on numbers, it is also shaped by expectations about future policy. When governments appear stable and committed to credible fiscal plans, markets are more patient. When leadership appears uncertain or contested, investors demand additional compensation for risk. In the United Kingdom, recent political shifts and declining approval ratings have added a risk premium to borrowing costs. The market is effectively pricing in uncertainty about how consistently fiscal targets will be maintained. Another structural vulnerability lies in the composition of UK government debt. A significant portion is linked to inflation. This means that when inflation rises, the government's interest payments automatically increase. The mechanism was designed to reassure investors that their returns would keep pace with prices. In a period of volatile inflation, however, it transfers risk directly onto the public balance sheet. Higher inflation leads to higher payments, which can widen deficits even if spending policy does not change. The pension system introduces an additional layer of sensitivity. Many pension funds use strategies designed to match long-term liabilities with bond holdings. These strategies often involve leverage. When bond prices fall sharply and yields rise, the value of those holdings declines. Funds may then receive margin calls, forcing them to sell assets to raise cash. That selling can push prices lower again, creating a feedback loop. The United Kingdom has already experienced a version of this dynamic in the past. The structural conditions that allowed it to happen have not fully disappeared. At this point, the connection between the three economies becomes clearer. Japan represents the origin of potential stress through rising domestic yields and the possibility of foreign asset sales. Germany represents the weakening of fiscal discipline in what was once the most stable anchor in Europe. The United Kingdom shows how markets behave when both fiscal pressure and political uncertainty are present simultaneously. These are not isolated stories. They are different stages of the same underlying challenge. The global bond market is highly interconnected. Investors compare yields across countries continuously. If U.S. Treasury yields rise because of foreign selling or funding stress, capital can shift toward those higher returns. To keep investors interested, other governments must offer competitive yields. This competitive dynamic forces borrowing costs upward across multiple regions, even if local conditions have not changed dramatically. As yields rise globally, fiscal calculations change everywhere. Interest expenses increase, budget flexibility declines. Governments face difficult choices between cutting spending, raising taxes, or borrowing more. Each option carries economic and political costs. Markets react to those choices, sometimes quickly. The result can be synchronized pressure across sovereign balance sheets. This is how a feedback loop forms. Higher yields lead to larger deficits. Larger deficits require more issuance. More issuance increases supply. Increased supply pushes yields higher again if demand weakens. At the same time, higher borrowing costs slow economic activity. Slower growth reduces tax revenue, which further widens deficits. The loop does not require panic to operate. It functions through basic arithmetic applied to large debt levels. Currency movements can amplify the process. In periods of global uncertainty, capital often flows toward perceived safe havens. If the US dollar strengthens, financial conditions tighten worldwide because many loans and trade contracts are denominated in dollars. Countries with weaker currencies must offer higher yields to attract investment. This increases their debt servicing burden and reinforces the cycle. Another accelerant is the unwinding of leveraged funding strategies. When investors reduce risk simultaneously, liquidity across markets declines. Lower liquidity means price moves become larger for the same volume of trading. Volatility rises, which prompts further risk reduction. This sequence can transform a gradual adjustment into a sharper repricing of sovereign risk. For businesses, the consequences appear through financing conditions. Higher benchmark rates increase the cost of issuing corporate bonds or obtaining bank loans. Projects that once seemed profitable become marginal. Expansion plans are delayed, hiring slows. For households, the effect is visible in mortgage rates, credit costs, and reduced access to affordable financing. The transmission from sovereign yields to daily economic life is direct. Despite these risks, outcomes are not predetermined. Financial systems also contain stabilizing forces. Central banks can provide liquidity. Governments can adjust fiscal plans. Investors can shift towards safer assets, which sometimes lowers benchmark yields. The final trajectory depends on how these forces interact. The uncertainty itself, however, increases market sensitivity to new information. From a strategic viewpoint, the key issue is the simultaneous presence of similar pressures across multiple major economies. High debt levels, aging populations, slower growth, and rising interest costs are not unique to one country. When several large systems face these constraints at once, the margin for policy error becomes smaller. A shock in one region can propagate more easily because others lack excess capacity to absorb it. The combined picture forms a coherent sequence. Stress in Japan can influence global funding through asset flows. Reduced fiscal credibility in Germany can widen European borrowing costs. Elevated yields and structural vulnerabilities in the United Kingdom demonstrate how quickly market confidence can shift. Together, they illustrate a broader transition from an era of abundant, cheap capital to one where the price of money is rising. In such transitions, markets often move ahead of policy. Investors reprice risk based on expectations, not only on current data. Once expectations change, restoring confidence can take time. Governments must demonstrate credible paths to stabilize debt, support growth, and manage demographic pressures. Without clear signals, yields may remain elevated even if immediate conditions improve. Part 4 therefore completes the framework. The situation is not defined by a single crisis, but by an interconnected feedback loop across sovereign balance sheets. Rising yields, persistent deficits, political uncertainty, and structural economic constraints reinforce each other. The system remains functional, but its tolerance for shocks is lower than during the period of near zero rates. For decision makers, the implication is straightforward. Monitoring sovereign bond markets is no longer a technical exercise reserved for specialists. These markets now transmit signals about future financing conditions, investment viability, and economic resilience. When several major economies begin to show similar stress patterns, the probability of synchronized tightening increases. The current moment does not guarantee a global crisis. It does, however, mark a phase where vulnerabilities are more visible and less easily contained. Japan, Germany, and the United Kingdom represent different entry points into the same challenge, managing high debt in a world where capital is no longer free. Whether the adjustment remains orderly or becomes disruptive will depend on policy credibility, market confidence, and the speed at which structural reforms can restore balance.